A crash in the stock market is characterized by a sudden and unexpected collapse in the values of the stock market, which typically occurs within a short period of time. This type of crisis typically occurs within a short period of time. In most cases, accidents of this nature are not the result of a single cause. Rather, they are the culmination of a number of various factors that are interconnected with one another. Downturns in the economy, political instability, psychological dynamics, and deficiencies in the banking sector are all examples of reasons that could be responsible for this phenomenon. The state of the economy is a crucial aspect that plays a role in the occurrence of stock market collapses. The impacts of an economy that is going through a recession, which is characterized by a reduction in economic activity across a variety of sectors, are experienced by a large number of individuals. Recessions are characterized by a drop in economic activity. It is becoming increasingly challenging for firms to generate new income as a consequence of the decline in consumer expenditure and the continuing rise in unemployment rates. As a result of the ongoing deterioration of the economic conditions, investors' trust in the company is suffering. Huge sell-offs occur in the stock market as investors start to worry that companies will not perform as expected, which results in widespread selling pressure. This causes the stock market to undergo huge sell-offs. Particularly noteworthy is the fact that this became abundantly obvious during the Great Depression, which took place in the 1930s. As a consequence of the economic collapse that occurred prior to the market crash, a feedback loop was created which consisted of a decline in investor confidence and a decrease in stock values. The negative feedback loop was a contributing factor to the overall economic depression that was taking place at the time. Additionally, fluctuations in interest rates and inflation are key elements that contribute to the incidence of market collapses. These factors work together to cause market collapses. Inflation, which is defined as the rate at which the general level of prices for goods and services is increasing, can have a number of consequences, including a reduction in the purchasing power of consumers and the possibility of more stringent implementation of monetary policies. As a response to rising inflation, central banks may decide to raise interest rates in order to reduce the amount of money that the populace borrows and spends. There is a possibility that this could bring about price stability, but it will also bring about an increase in the cost of borrowing money for both end users and commercial enterprises. The expansion of the economy can be slowed down by increased interest rates, which can result in fewer earnings for firms and a reduction in stock values. This can be a negative consequences for the economy. In the late 1970s, there was a market slump that occurred, which serves as an example that highlights how these economic issues could contribute to market instability. Increasing interest rates and surging inflation were the primary factors that led to this crisis. Additionally, the occurrence of economic bubbles adds an additional layer of complexity to the problem that is currently being faced. One of the distinguishing characteristics of a bubble is the fact that it can be caused by speculative investing to cause asset prices to increase to levels that are not long-term sustainable. In the presence of a bubble, the values of stocks and other assets surge as a consequence of investors putting bets on future profits, usually without taking into consideration the fundamental valuations of the assets. This causes the values of the assets to skyrocket. One of the factors that leads to the bursting of the bubble, which in turn leads to a considerable and rapid decrease in the prices of assets, is the failure of these optimistic expectations to materialize. The dot-com bubble, which happened in the late 1990s, is a good example of this. It occurred throughout that time period. An excessive amount of speculation in technological businesses led to inflated pricing, and as the market corrected, many investors incurred enormous losses as the bubble burst, which resulted in a severe collapse in the market. This was the consequence of the general correction that occurred in the market. In addition, political factors, which include geopolitical events and shifts in the policies of the government, are a factor that leads to the collapse of the stock market. Emergencies such as wars, terrorist attacks, or important policy shifts are examples of the kinds of things that might cause uncertainty and disruption in the financial markets. To give one example, the financial crisis that took place in 2008 was influenced by a confluence of factors, including geopolitical tensions and policy decisions that were connected to the housing market. It is also possible for political instability to be the source of market volatility. This instability can be generated by a variety of factors, such as the uncertainty around elections or scandals involving corruption. When faced with political unpredictability, investors have a propensity to move their investments to assets that are more secure. This can result in market declines that are considerably more severe than they would otherwise be. One of the most important contributors to the occurrence of stock market crashes is the way in which investors think and behave during the process. When investors encounter fluctuations in sentiment, usually brought on by fear or panic, this can result in a rapid sale of assets. Fear and panic are often the driving forces behind these shifts. When investors anticipate a decline in the market, they may immediately liquidate their assets in order to eliminate the possibility of incurring additional losses. There is a possibility that this may lead to a cycle of falling prices that will continue to perpetuate itself, which may result in additional damaging results. This was especially obvious during the period of the stock market crash that took place in 1929, when investor panic contributed to the severity of the market collapse. Other factors that can contribute to the deepening of market declines include herd behavior, which occurs when investors follow the actions of others rather than making judgments on their own discretion. The downward pressure on prices will be intensified if a considerable number of investors start selling off their stock holdings. It is likely that additional investors may follow suit, which will make the situation much more difficult for the market. Market crashes can also be caused by the practice of speculative investing, which is another factor that can result in market crashes. In the context of financial markets, speculation refers to the practice of making high-risk investments with the expectation of achieving financial rewards in the short term rather than concentrating on the fundamentals of the long run. When speculative investments fail to meet the expectations that were established for them, it is possible that the market will see a severe decline. A significant illustration of this is the collapse of the housing market in 2008, which was brought about by practices of speculative mortgage lending and investment strategy. This collapse was a significant example of this, as a consequence of excessive speculation in the property market, which resulted in inflated asset prices as significantly more widespread financial catastrophe was brought about. When the market experienced a correction, it was the factor that triggered the event. The instability of the market can be significantly influenced by the very nature of the financial sector, which can be a significant contributor. A credit crunch is characterized by a decline in the availability of liquidity within the financial system and causes borrowing to become more difficult. It can be caused by the failure of large financial institutions such as banks, which can result in a credit crisis. The failure of a major financial organization, such as Lehman Brothers in 2008, is an excellent example of how the failure of a major financial institution can create a crash in the global market. This crash occurred amidst the financial crisis that occurred in 2008. In addition, the utilization of complex financial instruments such as leveraged investments and derivatives may cause the risks that are linked with financial transactions to become even more severe. The significant use of mortgage-backed securities and derivatives was a major cause in the collapse of the market during the financial crisis that happened in 2008. This crisis erupted in 2009 and lasted until 2010. It is clear from this that there are risks involved with the advancements that have been made in the financial sector. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.